right, welcome to our third Thursday, and it is February the 15th, the third Thursday of 2024, February. And so tonight, what we're going to do is we're going to go through a little bit of how to set up the business. And I've talked about this quite a lot in the past. How you set your business up, how you set your rental properties up, how you set your investments up will decide how you get taxed. And by that, I mean the structure and the formalities of how a business is organized, how an investment is organized, how your real estate investments are organized, in large part determines the structure of the tax, the kind of tax, both today and in the future, particularly in real estate. You might have an operational platform where in the current day you don't have a lot of taxable income, but you are building a potentially big tax trap down the road when you get ready to dispose of the asset through a sale. And that usually ends up forcing people into the uncomfortable position of having to do a 1031 because they didn't set things up in a way that would give them benefits today as well as tomorrow on some future disposition. Well, a business works the same way. And so there are three aspects to business organization. And then we'll talk about how this relates to real estate investments, real estate development. All of these different attributes sort of spin off of how the core business is going to be organized and how it's going to be structured. And by structured, what I mean is what kind of tax structure are you organizing for your business or for your real estate activities or your investment activities? So just a quick review, you can do business as a sole proprietor. You can do business as a single member disregarded LLC, which means for tax purposes, the LLC is disregarded, has no tax features or benefits. You get the unpleasant misfortune of having to pay self-employment tax as if you were self-employed. The FICA, the Medicare, the high rate of the income tax, your self-employment tax, all of that applies. You can set yourself up as a partnership. You can set yourself up as a corporation and then either decide to be a standard regular C Corp, or you can make the special S election and be treated as a pass-through, where your profits and losses are passed through from the corporation to your personal return. Each of these business structures, which we're going to cover throughout this year, are going to give you opportunities to look both today and in the months and years ahead at your tax structure, and as equally important, your financial structure. And a good part of the business structure comes down to the objective. You know, your business objective is hopefully guided by the just pure capitalistic incentives of, you know, making a profit and taking that profit and reinvesting it back into the business. And then at the same time, looking at that profit from a standpoint of how much of that profit are you going to keep. And that's going to be determined and decided by the kind of tax structure that you set up. So we have a couple of different ways to look at this. We start with the business activity, and then we look at your investment activity, and then we look at any real estate activity. And the reason we look at these in separate views is because they have quite a difference in the tax structure and the tax impacts. Real estate investment activities have a very, very, very different tax character than a consulting business, or if you owned a donut shop. Your investment activities, if you're investing in stocks and bonds, maybe you're investing in crypto, whatever your investment activities are outside of real estate, we look at the investment activities because oftentimes there are inefficiencies in how the investment activities are set up. And particularly for long-term estate planning, if you're not looking at some of those issues, you could have the unfortunate position of limiting significantly if you were to pass away prematurely or become completely disabled. You would end up looking at probate issues or some other issues that would be a little bit more adversarial in terms of your tax exposure. So let's just start with the business and a real estate activity. And we look at the structure, mainly deciding what is the most tax-centric or tax-efficient and financially efficient way to set the business structure up. And generally, for the most part, a corporate structure and an LLC structure are going to be the most advantageous recommended path for the following reasons: the efficiency of the corporation serving as the management conduit for the LLC, and then the LLC holding the real property, the assets of the real property, and depending on its character and what its holding purpose is, the uniqueness of the LLC can then be sort of customized to your particular needs or financial objectives. So we look at real estate from three different lenses. You have property that you're going to buy, and you're going to hold it for 3 or more years, long-term holding. We look at property that you're going to buy and you're going to flip. So that means you're going to own it for 3 years or less. And then we have property that could be developed or could be rehabbed. Those are properties that are very short term, less than a year. And in any case, what we're looking at is what is the purpose of the property that defines its tax character. And then we go to work in deciding the best way to structure the LLC. So you literally could have as many as 3 LLCs, one for all the long-term holding property, one for all of the short-term holding property, and one for the development or rehab of property that you're going to go in and maybe you're going to buy a property, add an ADU, accessory dwelling unit, or what we used to call granny flat, and then flip the property or do some rehab. Each of those have different tax attributes. Each of those have very different tax character, and each of them lend themselves to having opportunities to significantly reduce the tax exposure, particularly for capital gains. So let's just assume that we've got maybe a 5-unit property. It's multi-unit, single or multifamily rental property. We're going to be holding it for more than 3 years, long term, and it's in an LLC. You and your corporation are now going to be the managing member of the LLC. And by virtue of that combination with your corporation, you've created a partnership in the LLC, and you're allowed to use the disproportionality rules of the LLC, which I'll get to in a moment. So now you are the shareholder of your corporation. You own all the stock in your corporation. Your corporation and you as an individual become a managing member of the LLC. You own, let's just assume, 95% of the beneficial interest in the LLC, and your corporation owns, let's just say 5%. Now, because of the tax laws and how LLCs operate, we can use what is called the disproportionality rules. And in the operating agreement, we can define and let the LLC, who is a 5% owner, actually have 95% of the profits and the losses from the LLC. Those flow up to the corporation. And now the corporation gets the benefit of that disproportionality, and the LLC as a partnership doesn't really have a tax consequence per se or a tax exposure, because we've now shifted that successfully to the corporation. The corporation then is going to operate as a management conduit to manage that property, that project, whatever. And whatever other business activities, and you can have as many businesses under the same corporation as you desire. The one thing that I see a lot of that's not necessary and is just crazy is people forming all kinds of different entities for all kinds of different things. And there's only a few rare cases where you need specific purpose corporations to do certain things in different ways. But for the most part, almost everybody could benefit by just simply having one correctly formed corporate structure and one correctly formed limited liability company, creating that conduit and that partnership relationship. At the point of the corporation, and here's where the IRS is really starting to dig in, and we're seeing a lot more, and we're going to see a lot more in terms of audits and enforcement, is the corporations, for the most part, most people are not properly setting the corporation up, and they're not adhering to the most minimum in the terms of corporate governance. And by corporate governance, things like keeping your minutes and your resolutions and the decision making of the corporation, making sure that you have an active board of directors, making sure that you have shareholder meetings and board meetings, and that you keep minutes of those meetings and formalize all of your decisions through minutes and resolutions, and that you maintain those in your corporate book and maintaining your corporate books and records. Outside of the financial records, the governance issues are a big deal. And if ever audited, the IRS generally will disregard the entity structure and tax the taxpayer as if they were self-employed. If you meet a legal challenge and you're the recipient of a defendant in a lawsuit, the attorney for the other side suing you could pierce the veil of the corporation because you haven't maintained or kept the corporate governance and acted like a corporation. And therefore, they're going to make an argument that you are no more than an alter ego of your corporation, and that the court should pierce the veil of the corporation and hold you personally liable for that lawsuit. So it's really an important feature of the corporation. If it's properly set up, you want to make sure that it's properly being governed. And part of that governance that we're going to dig into tonight is really the compensation of the officer of the corporation. That's you. And that's the first test where most corporations that are closely held, they're not adhering to the reasonable corporation requirements for compensation and salary for the officers of the corporation or the owners of the corporation. So what I'm going to do is I'm going to pull up a document. It's a little bit of a flow chart, and it will give us an opportunity to illustrate the example of what I'm talking about here. And let's see here. Why is it not letting me pull that up? I'm technically challenged for a moment. Hold on just a second. Well, let's see. For some reason, Alan, this is not working. Let me try it this way here. Okay. Make sure that's clicked. And there we go. Now we got it. All right. So on this flow chart, we're going to talk about the compensation that a corporation should have, particularly in light of how your business is being set up, because this is an area that has got a lot more attention from the IRS, and it's going to be a continued issue of focus for examinations. You file your corporate tax return and you don't have very much, if any at all, in wages to officers of the corporation. It's pretty certain that the IRS is probably going to take a look at that at some point. The general structure of compensation begins with 4 tiers. And how we go about deciding the amount of compensation, not only are we enrolled agents, but we also hold credentials as CVA, Certified Valuation Analysts, and that also includes compensation and benefit analysis and designing compensation plans for clients that allow us to take the knowledge and the skill with those credentials and actually sit down and work through making sure that the client has a properly formed structure and entity, but also that they have the proper compensation of reasonable compensation being designed so that if it's ever challenged by the IRS, we're not going to have those problems. Reasonable compensation is a subjective standard, and without getting into all of the details, I can tell you it's a bigger area right now for audit enforcement, because a lot of people are using the corporation and making disguised payments to avoid paying the tax on the wages. And what they're doing, in effect, is limiting the ability to use the corporation in a way that would give them significant tax benefits, because they just simply don't understand the rules, or whoever set that up for them basically didn't understand or know the rules to begin with. How do we decide what the salary of an owner of the corporation should be? Well, it's a subjective test based on the economic need. So basically, we go through a needs analysis worksheet, and let's just say with your rent or your mortgage payment, your car expense, your health insurance, your medical expense, your food, clothing, all of those things that we have, utilities, food, everything that we spend money on every month, we come up with a number that is our economic need. And let's just pick a number. Let's just say that that's $20,000 a month. And to maintain your current standard of living, that's how much you have to have every month to pay for everything and maintain your standard of living. All right. Well, once the numbers are defined as to what the economic need is, we're going to take half of that, 50% of that, and we're going to divide it into the tier 1 and tier 2 compensation buckets. These are amounts that are going to be fully taxable for tax purposes. You're going to be subject to federal and state income tax, federal and state unemployment tax, FICA, Medicare, all the taxes that apply to wages, but it's not going to be on 100% of the economic need. It's only going to be on 50% of that need, and then we're going to divide it into these buckets. You're going to have some part of that, let's say 20% or 25% as a base salary. You're going to get another 5 or 10% for personal time off allowance, for vacation and sick leave allowance, a car allowance. Why would you get a car allowance? Well, if you don't want to have to keep a mileage record and you don't want to have to suffer through recapturing the depreciation at 10 cents a mile on a vehicle when you trade it in or sell it, then the car allowance is the best alternative because you don't have to keep any records with regard to how much you use the car. You're getting that as part of your compensation. And it's the most cost effective and by far the most efficient tax centric way and financially centric way to handle a vehicle. So those two tiers are fully taxable, and that consumes the first 50% of the economic need. The remainder of the economic need are going to be into the buckets in tier 3, accountable reimbursement and medical expense reimbursement, which is a very wide list of things that we can cover: health insurance, over-the-counter medication, co-pays, doctor visits, driving to the doctor, prescription medication, all of those things for you, your dependents, your spouse, all of them are wrapped up under a medical expense reimbursement plan. Anything that's deductible or allowed as a deduction can be paid under an accountable reimbursement or medical expense reimbursement. It's deductible for the corporation and it's not taxable, nor is it reportable to you, the recipient, being paid these amounts under a properly drafted accountable plan. Then you might have other amounts that could be things like a home office reimbursement. But on the note of a home office, the limitation is that very often, because you have such a quantified limit on the amount that you can deduct and the square footage by which that amount is decided, it generally does not benefit much in the way of dollars that you're going to be able to deduct. So there's an alternative strategy that we use, and we've been using this for many years. It's been around for a long time, but a lot of people just are not aware of it. Let me bring up that document real quick. And I think the thing that we want to look to is, how do we take advantage of the tax strategies to limit the amount of tax that we're going to be paying, and at the same time get as much of the money as we can and keep that without having to pay any unnecessary tax. And so the tax laws allow you, under section 280AG, they allow you to be paid an amount 14 days out of the year for renting out your home to your business or to any third party, and whatever you charge for that rent becomes a deduction for the business that paid it, let's say your corporation, and it is not reportable or taxable income to you, the recipient, as long as you don't do it more than 14 days in a calendar year. Then you're going to be good to go. So let me just show you the significant advantage of doing this, because this is a plan that Susan and I use. And I'm just going to go to the end here. And we're going to look at the computation using a 1-day rental facility agreement that includes refreshments for corporate governance meeting, board meeting, and business development planning session. The daily rental rate shall be $4,750 a day. If I do that 14 days out of the year at $4,750, I get a deduction for the business of $66,500, which means for federal and state tax purposes, I'm saving $28,000 in tax. And I don't have to report, nor do I have to pay tax on the $66,500 that I received for the day rent, facility rent, to rent out the home for the day to the business so I can conduct these kinds of meetings, bring in staff, maybe bring in some clients, have a whole day just set aside where we're doing business development, governance, all of those things. Got to do those anyway, so might as well do it in a way that gives some tax advantage and harvest these tax opportunities. In some cases, we've got clients that are doing this, and it's more than $100,000 a year in the facility rent that they're able to pay and deduct for the business and not have to report and pay tax on their personal tax return. So going back to the design of the compensation and benefit plan and doing the economic needs analysis, Tier 4 would be an other amount, and it would be a facility day rent agreement, and we would make a determination using the credentials and the experience that we have as valuation analysts and enrolled agents. We would make a determination as to what that amount should be in the Tier 4 amount for the daily rent. Now, half of your economic need and more than half of your economic need is being paid by the corporation and fully deducted and not taxed at all. You're only being taxed on the Tier 1 and the Tier 2 level, and that allows you to do other things like setting up your retirement plans and things like that, which we'll talk about in other presentations. But for right now, we're just talking about the design of the compensation and benefit planning and the 4 tiers of what that looks like from your corporate structure. If your property LLC is paying 95% of the profits up to the corporation, and you're recharacterizing that in the compensation and all these benefits, you're taking that money out, getting a full 100% deduction, but only a fraction of that is going to be taxable. The lion's share of it with the day rental agreement is going to give you more than what your economic needs are, and it's not going to be taxable. If you don't have the reasonable compensation, the whole thing falls apart. And we have successfully represented clients who've been audited on compensation issues. So when we come in and fix it, this is how we fix it, so that if it ever gets audited again, they're going to be able to pass that muster. I think the thing that I'd like to point out that's probably the most impactful and powerful about this strategy is how simple it is to set up, and yet so many people don't do it. And I can't understand why they wouldn't do it, other than the fact that they think that they're going to have to pay some tax on the wages. And the bottom line is you're going to have to pay some tax at some level. You're either going to pay it now or you're going to pay it in the months and years in the future. If your business and your investments, particularly your real estate activities, if they're not set up and organized in a congruent way that gives you all of the financial objectives that you're trying to reach, then you're going to have a lot of inefficiency, and you're just going to continue either to pay now or pay later. And a lot of times what happens is clients get stuck in the decision without having many options to navigate outside of the extra exposure and tax. And I see so many people getting forced into believing that they have to do a 1031 because they just don't want to take the hit on the capital gains and have to do the recapture of the depreciation. If you had set up the corporate structure as a management conduit and let that be the managing member with you in the LLC, and let the LLC own the real estate, and use that disproportionality test, you wouldn't have to do a 1031, because all of those profits would be paid up to the corporation and then taken out in the recharacterization of salary, compensation, benefits, the day rent, all these different things that we get to use in the tool belt to help design the compensation in a way that allows you to keep more of your money and your capital working in the business and working in the investments, particularly in the real estate, and doing more of that. So I think the moral of the story is where we started, is kind of how I'm going to wrap it up. How you set up your business, how you set up your real estate activity, how you set up your investment portfolio from a tax standpoint is going to decide how you're going to be taxed both now and in the future. And if you have a structure that is not tax centric, then I can tell you it's going to be very inefficient either now and in the future, because you're going to be in a box where you're not going to have as many options in terms of what you're going to be able to do in navigating any tax exposure that you would otherwise not have if you had done a little bit of planning. And so this part of the process, we often refer to it as reorganization planning. We're going to take a business structure, an investment structure, a real estate structure, and we're going to look at it, do an analysis, tell the client what we find, and then come back with some recommendations on how they can reorganize or repurpose what they've got and make it much more efficient, make it much more tax centric and much more financially centric in terms of both today and in the months and the years ahead. The biggest problem are the capital gains, particularly on real estate, that get clients concerned. If you had a management conduit corporation with a specific purpose, LLC, and you had that set up before you dispose of that real estate, you're good to go. You can actually navigate and mitigate all of the capital gains by simply having the management fee and the conduit paid up to the corporation, and then take it out in all of these other different forms and characters and significantly reduce or eliminate your tax exposure. In addition, if you make certain elections on the stock of the corporation and wanted to sell the business by selling the stock, and you held it for at least 5 years or more, under provisions of the Internal Revenue Code, making that election, 50% of your capital gain up to $10 million would be tax-free. So you wouldn't do an asset sale, you'd do a stock sale. Let the person buy the stock in the LLC that owns the real estate instead of selling the real estate, because you have other tax advantages that you can trigger that would give you significant tax savings, and not have to get jammed into considering doing a 1031 when you really don't have to do a 1031. So it gives you a lot of opportunity to look at different methods of planning. What I'll do now is, we're at the half an hour mark. We try to go about 30 minutes or so. We've got a few people, and if you're watching this on the recording, you can always text in the email in the link below on the video, and send us an email for any questions, and we'll get back to you. If we have any questions, I'll take a few questions right now, and then we're going to go ahead and wrap up for this event of the third Thursday. Today is February the 15th, and let's see if we got any questions. Alan, got any questions?
No, I don't have questions. I'm good.
All right. What are your observations on the day rent, facility rent? What do you think about that?
Yeah, that's huge. That's a lot bigger than the home office. It's 10 times bigger than the home office.
And you don't have to keep all the records like you do for a home office, and
Yes.
you get 20x greater tax deduction.
Exactly. Yep.
With less hassle.
Yep.
Right?
Yes.
All right. Cool. All right. Well, I want to thank everybody for jumping on, and those of you that joined, and then for those of you watching, again, go down below, click the like and subscribe. And if you have questions, just hit the email down below on the YouTube, and we'll be happy to get back to you and answer your questions. Let me go ahead and what kind of verification needed? It's just basic normal books and records. You have to substantiate the expenses. So if you have a one-page daily rent agreement and a copy of the check, that's all the substantiation that you need. Now you have to justify the amount, but that's a pretty easy process to decide what that amount is. And it's usually by a square foot or a facility type arrangement. And it's certainly not complicated in terms of the record keeping. A copy of the check and a copy of the one-page day rent agreement, and that'll suffice any scrutiny by the IRS. You can't just pick a number, so you have to use a little bit of a rationale how you came up with that number. But remember, you're renting the entire facility of your home for one day to your corporation, okay? And the typical, at least here in San Diego, the typical average would be somewhere between $2,000 to $3,000 a day plus some add-ons. So you could get as much as $4,700 to $5,000 for a single day. Because if you were to rent that hotel for a comparable space to hold a meeting all day and do all of that stuff at a hotel, you'd be paying about the same amount for a hotel. So you're using the provisions of Section 280A, Subpart G, and you're taking advantage of that. And as long as you don't do it more than 14 days in the year, you're good to go. It's a very powerful strategy, and we can blend that into the compensation planning. Good part of everything that you're taking out of the corporation, if it's set up correctly, is not going to be reportable or subject to tax, but you've got to have at least a minimum amount in reasonable salary to start with. And that's how it all works. All right. Have a great night. I want to thank everybody for jumping on, and I look forward to our next third Thursday.